Meet Lucy. Lucy just bought her dream doghouse. She's so excited she could bark. The real estate agent told her, "Rent is throwing money away. Build equity. Own your future." Lucy believed every word. Lucy is about to learn a very expensive lesson. Let's rewind to 6 months ago. Lucy was renting a small apartment for 1,500 biscuits per month. Her parents kept saying, "Stop renting. You're making your landlord rich. Buy a house." Her friends kept posting photos of their new dog houses with captions like, "Finally adulting" and "Best investment ever." Lucy felt left behind. Lucy felt like a failure. So Lucy went house hunting. She found a cute doghouse for 400,000 biscuits. Perfect. But Lucy only had 80,000 biscuits saved. "No problem," the bank said. "We'll lend you the rest." Lucy was thrilled. She signed the papers, she got the keys, she posted a photo with the caption, "I'm a homeowner." She got 500 likes. Lucy felt like a winner. Fast forward to today, Lucy is sitting at her kitchen table surrounded by bills. Her dream is turning into a nightmare. Let me show you why. First, the mortgage. Lucy borrowed 320,000 biscuits at 7% interest for 30 years. Her monthly payment? 2,130 biscuits. Wait, wasn't she only paying 1,500 in rent? Yes, but it gets worse. That 2,130 is just the beginning. Month 1, Lucy gets a property tax bill. 4,000 biscuits per year due now. That's 333 biscuits per month on top of her mortgage. Lucy didn't budget for this. Her real estate agent mentioned it, but Lucy thought it would be small. It's not small. It's basically an extra rent payment every 3 months. Month 2, the water heater breaks. The repair doggie says, "That'll be 1,200 biscuits." Lucy asks, "Can't the landlord pay for this?" The repair doggie laughs. "You are the landlord now." Lucy pays. Lucy cries a little. Month 3, the roof starts leaking. Estimate to fix it? 8,000 biscuits. Lucy doesn't have 8,000 biscuits lying around. She puts it on a credit card. The leak gets worse. She puts a bucket in the living room. Very glamorous. Much homeowner. Wow. Let's add this up. Lucy's monthly costs: mortgage, 2,130 biscuits, property tax, 333 biscuits, homeowner's insurance, 200 biscuits, maintenance, average, 333 biscuits, HOA fees, 150 biscuits, total 3,146 biscuits per month. Remember, Lucy was paying $1,500 in rent. Now she's paying $3,146. That's more than double. But Lucy is building equity, you shout. Let me show you how much equity Lucy is building. In year 1, Lucy pays 25,560 biscuits in mortgage payments. How much goes to the principal? 4,200 biscuits. How much goes to interest? 21,360 biscuits. Lucy paid the bank 21,360 biscuits just for the privilege of borrowing money. That's not equity, that's just gone. Poof, vanished into the bank's pocket. So, Lucy's real equity after 1 year: down payment $80,000, principal paid $4,200, total equity $84,200, total spent $37,760 biscuits. In 2026, house prices are not doing great. Some areas are going up 2% per year, some are going down. Let's be generous and say Lucy's house goes up 3% per year. That's 12,000 biscuits in appreciation. Sounds good. Except Lucy paid $37,760 to get that 12,000 gain. That's still a 68% loss. And that's if the house appreciates, if the market doesn't crash, if a recession doesn't hit, if interest rates make everyone stop buying. That's a lot of ifs for a safe investment. Now, let's talk about what Lucy gave up. Lucy had 80,000 biscuits for her down payment. What if instead of buying a house, Lucy had invested that 80,000 in a boring index fund earning 10% per year? After 1 year, she'd have 88,000 biscuits. That's 8,000 in gains without fixing a single water heater. But it gets better. Remember, Lucy is spending $3,146 per month on homeownership? Her old rent was $1,500. That's a difference of $1,646 per month. What if Lucy had kept renting and invested that extra $1,646 every month? After 1 year with 10% returns, she'd have 21,000 biscuits in her investment account, plus the 8,000 from her original 80,000. That's 29,000 biscuits in gains, tax-free in a retirement account. Compare that to Lucy's homeownership. Equity gained $4,200, appreciation $12,000, maybe, total $16,200. Investing instead, returns on $80,000, $8,000, returns on monthly investing $21,000, total $29,000. Investing wins by 12,800 biscuits, and Lucy wouldn't have a leaky roof. Now let's talk about the thing nobody mentions. Lucy is trapped. A few months after buying, Lucy gets a job offer in another city. It pays 20,000 more biscuits per year. It's her dream job, but she can't take it. Why? Because she owns a house. If Lucy wants to move, she has to find a buyer, could take months, pay a real estate agent 6% commission, 24,000 biscuits, pay closing costs, another 8,000 biscuits, hope she sells for at least what she paid, and pray the market hasn't crashed. So Lucy stays. She turns down her dream job. She stays trapped in a house she can't afford, with a roof that leaks, in a city she wants to leave, all because everyone told her buying was the smart move. Meanwhile, her friend Jake kept renting. Jake pays $1,500 a month. Jake invests the difference. Jake got a job offer in another city. Jake gave 30 days notice and moved. Jake is thriving. Lucy is stuck. Let me show you the 30-year comparison. Lucy stays in her house for 30 years and pays off her mortgage. Total paid over 30 years. Mortgage, $766,800. Yes, really. Property tax, $120,000, insurance, $72,000, maintenance, $120,000, HOA, $54,000. Total, $1,132,800 biscuits. Lucy paid $1,132,800 for a house that cost $400,000. The bank got $366,800 in interest alone, and Lucy still had to pay all those other costs. Now, let's say the house appreciated 3% per year for 30 years. It's now worth 971,000 biscuits. Not bad. Lucy made 571,000 in appreciation. But remember, Lucy spent 1,132,800 to get there. Her actual loss is 561,800. But she got to live there. Sure, she also got to fix the roof, replace the HVAC, repaint, landscape, and deal with HOA complaints about her mailbox color. What if Jake rented for 30 years and invested the difference? Rent increased 3% per year, same as all Lucy's costs except the mortgage. Jake's average rent over 30 years about $2,200 per month. Lucy's average total cost about $3,146 per month. Difference, $946 per month. Jake invests that $946 every month for 30 years at 10% returns. Ending balance, $2,148,000. Plus, his original $80,000 down payment invested for 30 years becomes $1,395,000. Total, $3,543,000. Lucy's house, $971,000. Jake's investments, $3,543,000. Jake wins by $2,572,000. And Jake can sell his investments in 5 minutes and move anywhere. Lucy has to find a buyer, pay commissions, and pray. But Lucy has stability. She knows her payment won't change. Except property taxes went up, insurance went up, HOA fees went up, maintenance costs went up. The only thing that didn't change was her mortgage. Everything else increased. Here's the truth. Buying a house is an emotional decision, not a financial one. You buy a house because you want to paint the walls purple. You want a dog or 5. You want to feel settled. Your parents won't stop nagging you. Society says you're supposed to. These are valid reasons, but they're not financial reasons. Financially, in 2026, with 7% mortgages, high prices, and maintenance costs through the roof, literally for Lucy, renting and investing wins. A house is illiquid, can't sell quickly, expensive to maintain, ties you to one location, front loads interest payments, has massive transaction costs, appreciates slower than stocks, requires insurance, taxes, and HOA fees. An investment portfolio is liquid, sell anytime, no maintenance, go anywhere you want, compounds efficiently, efficiently, minimal transaction costs, historically returns 10% per year, no property tax, no HOA. So why does everyone say buying is smart? Because your parents did it when houses cost $50,000 and mortgages were 3%. Real estate agents make 6% commission, banks make $366,800 in interest over 30 years. Everyone wants to believe their decision was smart. Renters are seen as failures in our culture. But the math doesn't lie. Lucy is sitting at her kitchen table with a leaky roof and a broken dream. Jake is sipping champagne in his new city at his new job with 3.5 million biscuits in the bank. 1 year later, Lucy sells the house. She loses 30,000 biscuits after commissions and costs. She moves to an apartment, she starts investing, she wishes someone had shown her the math before she bought. Now you've seen the math. In 2026, with these interest rates, these prices, these costs, buying a house is a trap. It's an emotional decision disguised as a financial one. If you want to buy, go ahead, but don't call it an investment, call it what it is, an expensive lifestyle choice. Lucy learned this lesson the hard way. You don't have to.